Thanks for joining us, folks. Appreciate it. This is Market Call. It's the 115 edition. So you folks know Elizabeth flew down here just for this special. She got here late last night. She's leaving today. She did it as a favor for us. So we're very thankful for her presence here at this FactSet conference, which, by the way, is amazing. Over 400 people. We just saw Phil a few minutes ago. He's excited. We're excited. So thanks for joining us. But we're going to get right into it, because it's actually a pretty interesting market day as it shakes out.
Well, yeah, it's a day before what Liz calls, her 10 times a year Super Bowl.
8 times a year.
8 times a year, really? That's it?
Yeah.
FOMC meeting started today. It's a 2-dayer.
Well, it's always a 2-dayer.
Okay.
Today, this isn't a special 2-dayer.
I mean, we generally focus on the second day, but you're nerding out and looking at the tea leaves. You like to see what color tie Jay Powell's wearing.
It's always purple. There was one silver one mixed in there, but it's always purple.
All right.
Yeah.
So, well, I mean, we're gonna hit that. We're gonna hit a whole host of things.
Sure.
What we really want to focus on a bit, especially in front of this audience, we're really excited to be here. Guy and I have been FactSet users for over 2 decades, really, since we started in the business, and it's fascinating to us as we're talking to some of the experts and some of the product specialists and the chief product officer. You know, when we started in the business, it was very analog using these sorts of tools, and it's amazing the innovation that this company has had over, let's say, the last few decades, but specifically the last few years.
No doubt about it. And we talked to people this morning about exactly that. So I hate the term, but the hockey stick growth over the last couple of years is clear. So let's go to the rundown in terms of what we're doing here on today's show. As you said, FOMC preview for sure. We're going to look at some corporate earnings in the form of Amazon and Apple, which I think are going to be really interesting. I think they're going to be very different. We'll see. Stock market valuations, but specifically on the back of interest rates, 10-year yields have gone from 3.8% to we're probably approaching again 4.7%. We'll have that conversation. And most importantly, audience Q&A. So if you have questions, we're going to have a microphone in the audience. Feel free to ask whatever you want. Market stuff about Dan.
Well, you forgot, wait, you forgot one, like one of the most important things that we do on.
Oh, no.
I don't know what we're talking about.
I know what you're about to say. So typically we do this on Thursday.
Correct.
And we have this thing, and I apologize if I'm about to offend anybody.
No, but that's not.
If it's Thursday, what are we doing?
It's Butters.
And typically I then do a little, I throw a word in on the back of that. We've made John, do you guys know John Butters? I mean, he's a senior, you're not in your head, right?
Senior earnings insight analyst.
He's a star. I mean, but we've taken him to the next level.
But Liz,
no, it's like Butters, man. It's like right and wrong.
So every week, John puts out his earnings insight analysis. It's a Friday drop. We get a preview on Thursdays. And what we find most interesting, especially around this time of year, some of the work that he's doing really helps us think about earnings, some of the macro themes that are going within earnings and the like there. So we're going to talk a little bit about what he's got today, because I think it's actually really interesting.
It's actually perfect timing for it.
With Amazon tonight after the close in Apple.
Big week. Let's take a look. We can put this on the full screen behind us. There's a lot of data this week. There's a lot of economic stuff coming out. What caught my eye this morning was something called the Employment Cost Index, right? Yeah. And if you think about what people basically is saying, people have to pay more, companies have to pay more to their employees. Now, people will look at this number, which was hot today, and say, you know what? It wasn't more on the earnings front. It was on the benefits front. In terms of the benefit packages, basically, again, corporations have to pay their employees, but that's splitting hairs. The reality of the situation is the Fed sees this number come out, and this does not help their cause whatsoever, Elizabeth.
Yeah, I mean, you can see it, or if you saw it pop up there, it came in at 1.2%, hotter than what everybody expected. Who cares what they're spending it on?
Agreed.
It doesn't matter what the source of it is. It's that it's more expensive to hire people and entice people to come to the company and then keep them at the company. And playing that forward even more, you have to think about if employment costs are going up continuously for companies, but revenues aren't going up at the same clip, that's the definition of margin contraction, right? You're going to start to see pressure on margins because of it. So exactly at that moment when that number came out, you saw yields spike up, pop up a little bit. And then you see things like the expectation of a cut tomorrow going down to it went down to 1% at one point. Now it's back up to 3%.
Yeah, let's hit that really quickly. So again, this is FactSet screen for the Fed funds tracker, and it's really fascinating. When you think about coming into this year, this stock market rally that got sparked at that 2-day meeting back in December. back in December 13th, and the S&P just took off. And the expectations were for 6 rate cuts in 2024. You can look at this and you can say all of those cuts have been basically pushed out. Maybe we get one towards the end of the year. We'll talk a little bit about that, but kind of going back to the data, Liz, there was some other stuff. Consumer confidence. You and I did the On the Plate podcast on Monday, and we ran through a whole host, and these were kind of some quotes that we pulled out of some transcripts on the FactSet. About some comments about the consumer, the resiliency of the consumer. When you see data like this, what does it say to you?
Well, so one of the big pillars of the bull case had been the consumer, and still is to many people the consumer. And Guy will tell you, never underestimate the consumer's desire to spend. That's still true. Some of the issues already are that they're spending on credit, which hasn't necessarily reared its ugly head yet, but it's there. But confidence came out today. It's not the actual number was 97. Which is below 100. That's kind of a big deal. The idea here too is that this particular reading, consumer confidence, which I find interesting, this one skews more towards the labor market, and there haven't really been problems in the labor market as far as the data is telling us. So that means people are answering this survey with some concerns over the labor market that haven't shown up in the data yet. So that could be a little precursor. The University of Michigan one skews more towards inflation. But when you see what's happened with inflation over the course of 2024 already, and people just feeling it, I don't think it's any surprise that consumers are looking at it and say, yeah, I don't feel great. I don't feel as good as I did in January.
All right, so Guy, on Monday, Liz and I, we went back and forth a little bit about this, and maybe you can kind of break the tie here a little bit. If Fed Chair Powell is sitting
I'll break it in her favor.
all right, obviously. But if Fed Chair Powell is sitting with all the governors, all the geniuses, as you call them down there in DC, right? And they're taking this data that came out today, yesterday, last week, and the like, and we know that the all-important jobs number comes out Friday morning. Does Fed Chair Powell have a look at that April jobs data when they're going to kind of come up, whatever decision that they arrive at tomorrow, and he goes up the lectern and does the presser?
So I think your question is, does he have a heads up? Does he have
Correct.
a first look? I have no idea as to what goes on in terms of, I would like to think the answer is no.
Why would
The
you
world
like
is,
to?
well, I mean,
Why not? I mean,
you'd
if
like
you're
to
going to
think-
go out there and make a big, kind of proclamation about rates.
because he should be prepared regardless of number to be able to discuss what's going on. And the number is just sort of an afterthought in terms of, where he is. He should know what his answer is going to be predicated on certain numbers. Like, I don't need to know what the numbers are in order to be able to go and have a conversation ex post facto, as they say, for you Jesuitly educated people. That's after the fact, as opposed to a priori, which is before the fact. See what I did there? I didn't even rehearse that. With that said, he should be smart enough and sort of, I guess, deft enough to be able to address it. So I don't think he does. With that said, the numbers that have been coming out are not helping his cause. Now, to his defense, I mean, I would submit, and Elizabeth, you have thoughts on this, he's been hawkish all along. I mean, maybe the interpretation has been otherwise, but I think he's pretty steadfast in his desire to say, hey, this inflation dragon has not been slayed. We still have work to do. The market interpretation is what it is. The fact that last year in the fall, the market thought there were going to be 6 rate cuts this year, that never made any sense to me at all. Now, not to say that I was correct, but I looked at it and say, based on what? Thoughts on that?
Yeah. Just so everybody knows, Guy did break the tie in my favor, and he doesn't even know it.
Yeah.
So
I know
the rules are, and who knows if this actually gets upheld or not, but the rules are that they don't get a heads up on data unless it's going to be released during the meeting, meaning they're in a room, closed door. They do get a heads up if it's going to happen during the meeting. This one in particular won't happen until 2 days after the meeting. I don't think they get a
I think that's totally BS. If you think
It
about
might be.
Because there was a time when we started the business, the stock market did not move on like pieces of data, right? Like it just didn't. And so if you're thinking about this, if the data is April and the Fed is meeting right now, you know what I mean?
Yeah.
Like with April over, why wouldn't you want to incorporate that? Maybe it's just
Well,
semantics.
they have other stuff that they're looking at that should
This
end up
is the
lining up with
all-important
it.
jobs data.
Of
Liz.
course,
I mean,
I know.
the final.
Also, now we're going to get down a rabbit hole of this. But when you guys started in the business,
Uh-oh.
just shortly before me,
FactSet used to issue the reports by mail, by snail mail, when Guy started. So
No, but hold on.
But it was
There were
different.
They're tear sheets.
You actually
was
said
different.
something. You said to me earlier before the crowd came in, you said, At what point did you go all gray? Like, was it?
So when did you start going gray? And then what color was your hair before? And he said he had black hair. And I said, so you were salt and pepper for a while, and now
Yeah,
you're
you
just
say-
all salt.
Anyway, now it's all
He's
salt.
salty. He's
And
salty
it's-
already.
And it matches my personality.
It does.
Anyway, please
Yes.
continue.
So when you started in the business, the things that have changed since then and why the market trades on data is because the Fed talks too much.
Yeah.
They didn't talk as much then. They didn't have these 8 meetings per year. They didn't have all this transparency about what they targeted. And you can, if you guys really want to dig deep on Fed stuff, go back into the 90s and find out when they started to actually communicate their target and what it
that we had, right? So you had this Fed rate hiking cycle. And, you know, back in the mid 2000s, again, we had just worked off the excesses of a stock market bubble. We had the makings of a real estate bubble, obviously. And that's why rates went up the way they did. You know, Liz, you've talked about this a lot. You know, it's not, you know, basically the fear of the rate hiking cycle. It's the stock market starts to act really well in the pause period from that last hike. But it's really when they start cutting. And if we overlay the S&P 500 to this chart right there, the stock market is following, as a lot of you guys know this, rates lower here. And so the funny thing to me is that when the rate hikes started getting priced in late last year, and then obviously just took off earlier this year, you know, there was no fear that history was going to repeat itself in the stock market. And it still hasn't. We're only down, what, 4% from recent all-time highs.
Yeah, well, and the market bottoms typically happen, or almost every time have happened after the cutting cycle begins. Maybe once in a while they've happened right at that same point, but they don't happen during the hiking cycle. So the bottoms end up coming later. The thing that's interesting about this chart, I mean, you can obviously see we're at a high Fed funds rate. That's no surprise to anybody. But when you see just the speed that it went up, and then if you look at where we are right now, we know we're in that pause period. If we end up making it to where the market thinks we're going to make it to this time without a cut, which right now the first cut isn't priced in until December, if we get to November, it will turn out to be the longest pause ever. The most recent longest pause was in the 2006 to 2008 period. Obviously, we know what happened then. So then the question is, well, does that mean anything? If it's such a long pause, does that actually make it more dangerous? I think it does make it more dangerous. We're all sitting here waiting. We're talking about these long and variable legs. This is going to be one of the longest and most variable legs. And we're at the point where I always picture it like a rubber band that we just keep pulling back. It gets tighter and tighter and tighter. The longer we hold it high, the tighter it gets. And then the bigger the snap is on the other side.
We spent a lot of time last year talking about the inverted yield curve. For whatever reason, nobody's talking about it this year. It's become passé. But you've mentioned correctly that once we got through February, this has been the longest the yield curve's been inverted since the late 1970s, I think, into 1980-ish. Again, the market doesn't seem to care for whatever reason, but historically, again, it's not the inversion, it's when it re-steepens that things get concerning. And today, 2-year yields went above 5%. I think that's a number that's sort of catching people, not off guard, but clearly on top of mind. And then you have stubborn 10-year yields, you know, probably approaching 4.7. You can do the math, but what are your thoughts on the yield curve? People say it's different this time. I don't think it's different.
Well, so let me ask you that. Would you, when the 2-year hits 5, is that a buy signal, do you think?
In terms of equities or in terms of risk?
As an investor, is 5% the point where you're like, it's not going to go that far, but we got a Fed funds rate with an upper bound of 5.5, 2-year at 5, if that tracks the Fed as closely as possible? I mean, the work that we've done is that there's a little more upside risk in it. Maybe it gets to 5.25, but it probably doesn't go much higher than that, even if inflation continues to come in hotter, right? And even if cuts get pushed out further. So to me, the 2-year at this level is actually a pretty good investing opportunity.
Agreed. Now, the flip side of that coin is, and then we're going sort of a bit off script here, but 10-year yields, I think, will continue to move up for a myriad of different reasons, not least of which all the issuance has to be done, number one. And number two, the fact that, you know, there are a lot of players out there that have historically been buyers of that might be sidelined now, not least of which, again, Bank of Japan. Not to suggest, again, people won't buy our debt. It's the rate with which they will buy our debt. And you're starting to see it in some of these treasury auctions.
Well, let's bring it back to the stock market, because again, I think this higher for longer thing is not something that most folks had been pricing in. Guy, you were definitely in the higher yield camp, but that also has this upward pressure on the US dollar. Liz, you were just talking about margins. Okay, so we're what, 3/4 through S&P 500 earnings season right now. We obviously have a lot of big ones the rest of this week or so. We haven't seen a ton of margin pressure just yet. Okay. But when we think about some of the things that we've seen already, Guy, are there any, and we're going to flash up, let's say, this week's earnings, is there anything that kind of leads you to believe, and we're going to get to Buttersworth. I think Buttersworth is really important here. Is there anything that you've seen so far in earnings season that makes you a little bit worried as we get into like kind of the mid part of this year?
Yeah, we have it behind us. McDonald's reported earlier today. And if you go back to their last report, I mean, and we've been doing Fast Money now for over 17 years, and I don't ever remember it. And, you know, could be my memory or it could have never happened. The CFO of McDonald's basically coming out and saying, you know what, our customer, and I'm paraphrasing a bit here, but our customer's a little strapped. Like they're feeling the pressure of prices increasing and they're trading down. Now, the question is where you trade down from McDonald's. That's another conversation. But the fact that they brought that up is absolutely concerning. And they didn't do anything today to assuage any of those concerns. So people are feeling it without question, not only in a McDonald's, but if you look at what the dollar stores have said on the one end of the spectrum, and then the flip side of the spectrum, even the high end companies, the high end retailers have been feeling it as well.
Yeah. So Liz, you know, we talked about that ECI number. Okay. Like this is a real, so going back to margins too, I mean, is inflation becoming embedded in the economy, right? And so then if we get to a period where we just had that GDP print that came in below expectations last week, do we run the risk of getting into a stagflationary environment? And talk about things that most people in this room, certainly in my lifetime, or at least my investing career, we have not been exposed to how risk assets perform in a stagflationary environment. So thoughts on that, because I know you guys have done some work on that.
Starting with, is inflation entrenched? First of all, the Fed cares about that a lot. That's one of the biggest pillars. They don't really talk about it all that much outwardly because there's not a specific measure that they've agreed on as being the one. But what we tend to look at is break-even rates. And if you look at just 2- and 5-year break-even rates, which is basically where it makes you indifferent between buying an inflation-protected security and a nominal security, they've shot up this year. So 2- and 5-year break-even rates are up quite a bit. 10 years are up as well. And that's what's going to make the Fed uncomfortable. Everybody thinks that it's, you know, jobs data moving in a tiny direction. I think CPI makes them uncomfortable too, but it's the entrenchment of it, because then the economy ends up in this cycle. And that's where you start to have the threat of that cycle just continuing, and their tools, which we've talked about before, their tools are no longer effective in a cycle like that. So that is something that's going to continue to concern them. And I continue to believe that the Fed will have a lot more stamina than the market wants them to through this cycle for that reason alone.
All right. Does stamina, Guy, mean that they start raising again?
You look at me, again, you use that word, and I could see the grin on your face.
No, but my point is that you've thought that the 10-year is going to get back to 5%.
Yeah.
If the inflation data remains really hot, do we start pricing out all cuts? And do we start pricing in? And there's been some movement in the options market, the futures market, that there could possibly be a cut. Or
a hike. We talked about that
earlier
earlier this year, and people thought we were a little crazy. And at one point, I think there was like a 3-4% chance. That's probably ratcheted up in a pretty significant way. By the way, I don't think that's going to happen. I don't think Elizabeth thinks that's going to happen as well. But the market clearly thinks there's a chance of that happening. And by virtue of that alone, the fact, again, going back to 6 rate cuts this year, and the fact that we've been talking about potential hikes, the market's not pricing it in. Might as well throw up an S&P chart, which I think we had up for a while. I mean, the S&P has been extraordinarily resilient. The market has been amazing. And full disclosure, you know, last year, I thought we were going to see a lot more downdrafts than we did. It did not happen. It was lower left, upper right. Now you're starting to see some things around the surface that should, I think, concern some people. And we'll see. And I don't want to get crazy here. I don't want to be hyperbolic at all. But you go back to a couple weeks, specifically that Friday, March 8th, when we saw a ridiculous day. And Amanda, if you could throw up an NVIDIA chart, you'll see exactly what I'm talking about. Again, this is not about NVIDIA. It's about the chart formation that we saw on that day. On that day, on that Friday, NVIDIA made an all-time high. It then subsequently lost approximately $250 billion of market cap. For context, I think there are only 55, 60 companies in the world that are that big in the first place. And we lost it like that. The market, NVIDIA has never recovered. We've challenged, it's never gotten back there. I think the broader market is starting to take its cues off that day, and we'll see what's happening. But again, to get back to the whole, embedded inflation,
Yeah.
absolutely. And I think whether they acknowledge it or not, I think they understand that it's a problem.
Really quickly on the S&P, if you can put a 5-year up here, and one of the things that's kind of interesting, you see that rising 200-day guy. I think you and I both kind of feel like if you go back to the prior all-time high, it's 4,800 in the S&P 500. Last summer, we had a intermediate high of 4,600. We had a 11.5% sell-off from the highs in July to the lows in October. We've obviously seen that ramp. A good part of that ramp was higher than expected growth expectations, plus the expectation for rate cuts, I guess for the right reasons. You and I are most likely, we're probably in the same camp that we think a retest that 4,600 level would kind of be healthy for bulls. You know what I mean, Liz? So thoughts on that and getting back to that kind of moving average.
And that's the kind of stuff that'll get you accused of being a perma bear and, why does it have to be so low? The line that shows the rally that happened, the S&P went up 27% from the end of October to the end of March. So in 5 months, it did the work of about 3 years. And the pullback that happened, we got down 5%. I mean, this little bounce, okay, who knows what's going to happen there. But I think there are a decent amount of investors out there that are saying, I wanted more than 5%. I was looking for an entry point somewhere that I didn't have before. I missed that run up. I wanted more than 5, and we might get more than 5. And we're in an environment right now. I've said this for the last week or so. We've now gone back into an environment where it's whiplash. It's going to be every day. It could be up 250 points in the Dow. The next day could be down 300 because we are at the mercy of every data point, every word that comes out of Powell's mouth. And some of these big companies of earnings, there's a handful of them that seem to matter to the entire market.
Yeah.
And it's outweighed.
Well, I think that's really important. I think that's why Guy brought up NVIDIA in particular. This is a company that a year and a half ago had a $250 billion market cap. It had sold off 70-some% from its 2021 all-time highs. The generative AI story starts to take hold at the end of 2022. You know what I mean? We have this bang up year in 2023 and a handful of names. You know what they are, the Mag 7. It's only the Fab 5 now, but NVIDIA now with a $2 trillion market cap is important. Let's go to John Butter's work. I think this is really important. So he updated this. This is in the Earnings Insight blog. And this is why we focus on some of these big names here. And so this is part of his report detailing the reliance of the S&P 500 earnings on these top 5 names. So the top 5 positive contributors year-over-year earnings growth for the S&P 500 for Q1 2024 are all Mag 7 companies. Overall, the blended actual estimates earnings growth rate for the entire S&P 500 is 4% for Q1 2024. Here's the really important part. The blended earnings growth rate for NVIDIA, Amazon, Meta, Google, and Microsoft combined at 78.7% for Q1. The blended earnings decline guy, okay, for the other 495 is down 3.7%. So you see the heavy lifting that's going on by these 5 stocks, and they're all really focused on this one market theme.
AI, to a large extent. And it's fascinating that those companies are able to, I'll use the term, mask the underlying weakness of the other 90-something% of the companies out there. And that's great when you look at, market and see the S&P going up and you say everything is fine. But again, we speak to this all the time. Below the surface, there's been damage being done. And John's work, we can talk about it all you want, but when you see it written for you, his work suggests that maybe we should be paying attention instead of the top 5 or 10, the other 490.
Yeah, but Liz, last week, Meta, this is a company that was a $1.2 trillion market cap on the day that it closed before it reported their Q1 earnings. Guy and I are sitting on the set of Fast Money, and the news is coming out, and the stock at one point was down 20%. Okay, so just think about that. So they guided up expenses $2 billion, and they guided down sales for the current quarter down $2 billion, and there was $150 or $200 billion market cap move. And going back to their Q4 earnings, and I think it was early February, the stock was up 20%. So think about that, like how things have gotten so out of whack, and then you think of this data. So how do you think about that? We're losing these components of the Mag 7. Apple has been a huge underperformer. Tesla has been a huge underperformer. And they are really, their year-over-year earnings declines in these companies. So at some point, why NVIDIA is important to us, at some point, this deceleration in their growth is going to happen, and it's going to start working its way into this data that Butters is tracking for us. So thoughts on that, because when we get to Butters' next slide about what's expectations for the back half of the year, that's the thing that concerns me a little bit.
Yeah, well, in order for NVIDIA's growth expectations to continue at that clip, you need companies like Meta to say that they're going to spend like that, and they're not going to keep doing that, especially if we're now in a period where companies are getting punished for being spendy, and that seems to be what occurred. And I think this is a year where investors want you to manage your margins, and being too spendy with not a lot of revenue growth is not a way to manage your margins. So if you look at it, it sort of became a zero-sum game this quarter, right? You've got companies that say, we're going to spend a bunch, investors punish them for spending, but then, okay, where's that money going to go? So I'll go reward the companies that are going to get that spend. The pie stayed the same size. I think for a while, the idea was that AI was going to make the entire pie bigger. Everybody was going to be more productive. Costs were going to go down. Yes, it was sort of a 5 to 10 year story, but we were okay with pulling it all forward. And now it's like, oh, wait, the pie is as big as it was going to get for now, and we have to just move the pieces around. So it became zero sum.
Yeah. All right. So this is what is also important to me. By Q4 2024, analysts expect double-digit earnings growth for the other 495 companies in the S&P 500. Overall, the estimated earnings growth rate, the entire S&P 500 in Q4 2024 is expected to be 17.2%. NVIDIA, Amazon, Meta, Google, and Microsoft combined are projected to report earnings growth of 20.7%. So a massive deceleration from Q1 to Q4. The estimated earnings growth rate for the other 495 companies in the S&P 500 is 16.6%. So if you guys are telling me that a big chunk of that earnings growth is coming from multinationals, we have a US dollar that's up 4.5% year over year. We have rates higher. We have a lot of commodity costs higher. So input costs are higher. We just talked about employment costs and the like. Guy, how does that happen in Q4 2024?
Well, this is the catch-up trade right here. I mean, what you're looking at speaks to exactly that the rest of the market is finally going to catch up in the form of earnings growth, and that's what John's work suggests. But then you start to see and look at his work and start to read between the lines and look at some of the inputs and say, how are those numbers going to be possible? I mean, it's very hard for me, and Liz can talk about this. We had a GDP that came in. I mean, again, I'm not being hyperbolic, but that was a disastrous number in terms of the actual number, more so in terms of the inflation component of that number. You had slowing growth, higher inflation. And when you start to put those two things together, it speaks to margins, but you also say, how are these companies going to get to the numbers that you see behind me? And I don't know if it's possible.
And you have an S&P that's trading, and again, John tracks this every week. You can look at his work, at 21-ish times is well above its 10 and 5-year averages of, I think, 18 and 17% respectively. So at some point, something's got to give on the valuation front.
Well, the S&P is priced for this to come in exactly like this, if not better. It's actually priced for the green bars to be higher every quarter. And maybe that materializes, but it is difficult to try to figure out where the demand will come from. The GDP number, for anybody that doesn't look at the numbers as closely, 1.6% was the GDP number for the first quarter. Long-term trend GDP is 1.8%. So not that much below long-term trend, but below. And investors didn't like it. The market didn't like it, I think partly because we had a mental threshold at 2, and anything below 2 was bad. And people got upset. I think there are mental thresholds for a lot of these numbers. But if you strip out from that GDP number, if you strip out government spending, government jobs, some of the stuff that isn't controlled by consumers, the number still looked okay. It was about 3%. So that would be the rebuttal, right, to what we're saying is that, well, private consumption and consumer consumption is still strong enough that maybe it maintains it. And maybe it does, but 20 times forward earnings means that we don't have room for really any mistakes.
Yeah, we want to take questions, but we also wanted to hit something really important. So Guy and I and Liz, we do a couple podcasts together. We do CNBC's Fast Money. She does Halftime Report and Closing Bell. And we use FactSet's tools all day long to kind of come up with a lot of the analysis that we do. We're talking a lot. We want to be really accurate about the things that we're talking about. So like, for instance, I have the FactSet app up right here as we're doing this. We do that on the set of Fast Money also. But sometimes it's really interesting. We get lots of questions all the time from like our viewers and our listeners of like, what are the tools that we use to come up with a lot of this content? And we want to just give you guys a quick example, like as we're like just going to riff on Amazon, which reports after the close tonight. And there's a couple things that we always like to speak to a little bit. And a lot of it has to do with our expertise and how we kind of formulate trade ideas or like just kind of commentary in and around results. So if we look at Amazon, reporting tonight, we already had Google, we had Meta, we had Microsoft last week. This is kind of an important one too. We'll start with like kind of the implied move in the options market to just kind of get a sense of like, how much options dealers are expecting it to move the day after it reports, how much it's moved in the past. And so we'll throw up like an options chain, and we'll do simple things like this. We'll look at the weekly at the money straddle. And if none of you guys are options people, it doesn't really matter, but you'll hear people talk about implied movement all the time. I'll look at the at the money call premium plus the at the money put premium. So basically where the stock is trading right now for the weekly options. I'll put them together and I'll get a dollar amount. This is $14.50. I'll divide by the strike price, and it's about 8% in either direction. Then I can go look on FactSet and I can see how much it's moved on average the last 4 quarters. Now that's just qualitative sort of stuff. I'm kind of thinking about how I kind of think about expectations. I'll look at kind of analyst estimates. I'll look at how much they're expected to be up year over year. Are they easy comps? Are they difficult comps? How analysts have moved their ratings, and all of this stuff, as you guys know, is all there in FactSet. So those are the sorts of things we like to look. We look at technicals. Guy, this chart right here, that one little that bar that's sticking out of nowhere, that was in sympathy with Meta when it was down 20% in the after hours. I think it opened down 14% or so. So it went down in sympathy. It bounced back with Google and Microsoft. How are you thinking about Amazon? Big implied move on a $2 trillion market.
Man, if you can't do this, I apologize, but it would be helpful. So you see that chart of Amazon. If you go longer term chart and go out 4 years, you'll see, thank you, that we're up against levels that we previously topped out at before. Obviously, you saw the sell-off in Amazon on the back of Facebook. I guess it made sense. So here's the question that people are going to have to ask themselves. Again, with Amazon, they can move certain dials, they can ratchet up margins, and whether or not they do it or not, that's sort of what the street reacts to. Why Microsoft went up, it was a reacceleration of growth in their cloud business. The question is that a rising tide for Amazon, or are they taking away from Amazon? I'm not smart enough to know the answer, but that's what we're dealing with right now. If I look at this and say, this is pretty interesting. You know, we saw a similar chart formation in Google. Google crushed it, made new all-time highs. We're in a different sort of level in terms of where we're trading. Amazon sets up eerily similar to that. I'm not suggesting the same thing's going to happen, but that's why we look at this to understand, okay, what's the implied move? An 8% implied move is not insignificant at all. Now, if you're asking me to play stock market here, I'm a little scared to the downside. I think it might have been a Microsoft specific thing. I don't think you're going to see the same type of growth with AWS. I'm not suggesting I'm right, but we try to do things, again, ahead of the curve, not behind.
Yeah, one big point, Liz, before I want to get your take on this, is that what's the difference between Microsoft and Microsoft invested in OpenAI. They're deploying their generative AI tools across their productivity suites, across their Azure, their cloud. They're getting a lot of benefits of all that. You know, when you look at Amazon, they're developing some of their own generative AI tools, but they're really investing in Anthropic, and they have a bunch of other products and services from some other generative AI companies on AWS. But, you know, the growth rate in Azure versus AWS has been lights out, and not great for AWS, which is the market leader. But Liz, when you look at a name like Amazon, there's a lot of stuff for you as a macro strategist you can think about. There's enterprise spending, there's consumer spending, there's stuff on the margins, there's international, there's a whole host of things. What do you look at when you look at a name like Amazon, how it factors into kind of some of your top-down analysis for the markets?
When I look at any name, and I think Amazon is a good example of this, if you're thinking about it from a macro perspective or even from a consumer perspective, how sensitive is it to changes in consumer preferences or changes in spending? And if you want to compare it to something like Microsoft, I mean, Microsoft is a software company and has been for a very long time. Their revenues are stickier, right? Software is a stickier revenue stream. You have a lot of enterprise spending that happens that way, and it stays on for years at a time. So yes, they're innovating. Yes, they're going to be sensitive to whatever the trends are in AI, or if they're managing their operating margins properly. But Amazon is going to be much more sensitive to changes in consumer behavior, changes in enterprise spend, because they don't have that sticky stream. It's not the biggest part of their revenue stream right now. And so I think Microsoft is a little bit more insulated from some of that stuff.
Take questions?
Yeah. So by the way, I mean, Guy and I do this every Monday through Thursday at 1 p.m. Liz joins us a couple days a week. We do Monday together on the Tape podcast. We do Market Call on Wednesdays. So you guys can check that out. And what we are using, Amanda really is the brains behind this whole operation. She's back there doing all these charts. We're doing this live on our YouTube page at Risk Versal Media. So you guys check that out. We take questions most days on there. So You guys have questions now, how we use it, about the markets, anything. We'd love to hear.
I think there's microphones in the crowd. So if anybody has, you can ask anything you want, market related, CNBC related, whatever you want. We're here for you. So, and again, thanks for having us. In the meantime, while we're looking for questions, Amanda, throw up an Apple chart real quick, because Apple reports, and, Bernstein they just upgraded the stock, I believe. I want to say they raised their price target. I respect that ahead of earnings. A guy named Tony Sacconaghi, who we all know, I actually worked with for a period of time, and I admire the call. I don't necessarily agree with it. I'll say this about Apple. It's a great company, obviously. There's nothing not to like, except that you're talking about a company that right now is trading around 25 times next year's numbers, with earnings growth rate of about, 8-ish%, revenue growth, 8-ish%, and margins that have been flatlining now for the last couple of years. So throw that on top of a China problem, which is a problem, and you're looking at a company that, quite frankly, hasn't performed since July of last year.
Yeah, and also, this is a company that's been a huge contributor to S&P 500 earnings, right? Over the last few years, they buy back a lot of the stock, they massage their earnings, and so it's just not growing anymore. So when John's work that we were just highlighting before, it didn't make it into those growth estimates because it's not growing anymore. So trading at 25 times, and guys said, there's not a lot to like. I don't find a lot to like about Apple right now. Might it rally 5% if it's not as bad as expected? You can see by this chart, it's really underperforming the S&P and many of its mega cap tech peers. But to me, they obviously have a China problem. They have a stale, iPhone problem. They have an issue with like margins that have just gone sideways. If they don't have generative AI, there's nothing going on interesting there. They don't have their own model. I don't think they have to build their own model, but they need to come up with a strategy that's going to cause users to get back upgrading their products, which they haven't done a whole heck of a lot. All right, do we have any questions here? Hannah's got a mic. There's one right there.
Thank you, sir.
Hey, thanks. Probably you kind of semi-answered that, but off the back of the Butters side, are you saying that Gen AI is basically those 5 companies and the other 495 are ex Gen AI?
No, I don't want to say that. I mean, that's not true. Obviously, within that family of 495 stocks, there are going to be companies that have FactSet, for example, is one of them that have incubated and integrated AI. But I think that stocks that we predominantly talk about are those 5, 7, 10 different names that obviously that's top of mind for people.
Well, I have a very specific answer to this. So the headlines about Microsoft's results last week wasn't that they're seeing some huge boom from generative AI. Now, maybe in their cloud, right? But they made this investment in OpenAI. They're able to kind of put this throughout. So they're not seeing the revenue growth right now. What they're seeing is multiple expansion in their stocks because people are interested about what it might mean in the future. So when you think about like valuations for the stock market, it is affected predominantly by those 5 names, which have been the beneficiary of the interest, at least in the public markets. And by the way, you're seeing it in the private markets. I could rattle off 5 names that are trading at 20 billion plus. OpenAI has got 85 billion market. Anthropic, Cohere, a bunch of goofy names like Huggy Face and stuff like that. But I mean, like, this is going on everywhere. So when you hear that term bubble, we get destroyed on Twitter if you were to say that on Fast Money or whatever. It's different this time or whatever. It's really not different directionally. But the companies that are benefiting in the public markets have tons of revenue and they have tons of earnings. They're just trading at very high multiples relative to what they've been able to realize right now about generative AI.
I think we have another question there.
The question is on NVIDIA. It's been flip-flopping, or the stock has been flip-flopping quite frequently. 10 days ago, dropping 10% on no news. What's your view on the company, and why is it reacting to both idiosyncratic as well as Powell, speaking news, as well as can it tolerate its implied vol of sort of 55 to 60%?
That's a great question.
For a long time.
All right, so Amanda, this is an NVIDIA chart. So again, I'm a bit of an armchair technician in terms of looking at things, but again, I mentioned March 8th. So if we can sort of make this a little bit smaller and focus on March 8th, you'll see a pattern, and there it is right in the middle of the chart. I mean, that is a pattern that you don't see that often. And if you can put your cursor on it, Amanda, so the folks can see right there. So on that day, it was a Friday, you had a stock that made an all-time high, and then it subsequently made it, you can see it closed on the lows of the day. And it was an engulfing pattern in the form of the prior day in a meaningful way with a new all-time high. You don't see things like that in my world all that often. And although we challenged that prior high in the ensuing couple weeks, We never were able to breach it. And since then, the stock has traded lower. To your point, we saw a 10% day. It has bounced since, but you know, it is a stock that is seemingly trying to, for the first time in a long time, find its footing, which is not an indictment of the company at all. No question about it. It is an amazing company with an amazing CEO who was just featured on 60 Minutes the other night. The issue I have is, again, you know, the valuation that people are paying for them. They're sort of outkicking their coverage in terms of price to earnings is very reasonable. Price to sales is not at all. And at some point, if you start to see margins contracting, which I think you will, that's when things start to go a little haywire. And I don't know if it's this quarter coming up or a couple quarters from now, but when they come out and say things are moderating or slowing,
well,
that's when the rug pulls.
But here's the thing. I can just go to FactSet estimates and I can look. This year, expectations for earnings growth are 80% and 80% plus for sales growth. Okay, margins, they just guided to, you know, like high 70s or something like that. But they did say on their last call, this was in February, that those margins are going to be peak. Okay, and so when I think about this, well, the stock was up 80%. At one point this year, the stock was up 100%. It gained $1 trillion in market cap. I've never seen that in my lifetime.
Well, nobody's ever seen
No
it.
one's ever seen it. So if your antennas are not getting up, and then what I do is I go look at the out year estimates, which are calling for, let's say, 20% earnings and sales growth. So at some point in 2024, there's going to be a quarter where they guide to a deceleration below what the street is expecting. And that's the quarter where that 10% move that you saw in 2 days over the last couple of months is going to look like you wish it was only 10%. Now, I'm not trying to scare you out of your NVIDIA. Great company. Like, they're doing amazing things. But tonight after the close, and AMD is going to report. Let's pull up an AMG chart. AMD, and guys said this a couple times in the last week or so, we were actually in Miami. It was January 30th, so about 3 months ago, when they reported. That's weird. 2 quarters in a row. We're both in Miami. When AMD,
I was here too.
And they,
Elizabeth.
oh, you were with us. All right, and we're going to let her talk for a second in a few minutes. And they reported a quarter.
I remember that.
And we were doing fast money from there. And you and I are looking around. We're like, this was a bad quarter. This was a bad guide. And this was going to be the next coming of AMD, right?
And the stock traded lower in sympathy. And it got back on its horse on the back of a lot of the, NVIDIA news and Microsoft news.
Look what's happening.
So that subsequent move higher on the back, that was all multiples. It's all multiple expansion. It had nothing to do with
the
AMD.
Belief that they were going to join the party with some products that were going to compete against.
By the way, we're now below those levels.
The multiple expansion thing is important, I think, for any of these stocks, because part of your question was why is NVIDIA moving on Powell's comments and things like that. The momentum that they saw upward, yes, some of it based on fundamentals, but a lot of that momentum too was based on macro, and it was based on just investor interest and the theme and the optimism around it. So I think some of the chops that you're seeing, and they're all chopping for different reasons, but some of it, when it seems like it's unexplained, if you could parse out, well, this much of the rise was due to actual fundamentals of the company, and this much of the rise was just due to multiple expansion that was made possible by the expectation of cuts, lower yields. That environment is now gone, or is at least pushed out into the future. So investors have to sit back and ask themselves, if I bought this company on the premise that growth would be more possible or more enjoyable because rates were coming down, now that thesis is busted, at least for a little while. So I think that's why you're going to see the reaction to the macro news.
All right, we have time for one more.
This right here.
So Tesla, it hasn't performed well in the long run, but it's been jumping recently. Yesterday up like 15%. So what do you think about Tesla for the long run?
Not a whole heck of a lot.
All right, so just you got to do like a public service announcement ahead of this. You have a love-hate relationship with Tesla.
Love-hate? Where's the love? There's no love.
It's a hate, because to me, this encapsulates, like, every market cycle that I have been, and I'm just going to be really quick on this, has had some bubble boy, right? Like, and it's had some situation that was different. It was special. It was unique, and, it's interesting when you just look at this. And so here's the 5-year chart. The stock, the highs in 2021 when Elon Musk was selling billions of dollars of stocks, like tens of billions of dollars of stock, was above $400. Look at how it's massively underperformed the S&P 500. The story was a great growth story. He's done amazing things with this company, perpetuating, EVs and the like here. But almost every decision that he has made over the last couple of years has actually been wrong. And so to me, I just don't find it, I don't like cult-like stories. I don't find it interesting. I don't like the valuation, the competition's coming, the bounce that you're talking about, he goes over to China, he talks about full self-driving. It's in the US, it's not even allowed to be called full self-driving. It's called supervised full self-driving, okay? So, and they're trying to sell it, they're cutting costs, a whole host of things. I don't find it interesting. That rally, go look at that. There's 4 gaps in the last year when the company's reported earnings of 10% or so. It gapped like that after it reported its Q1 deliveries early this month. It's since bounced, but every one of those gaps lower after the results has actually been followed by a big rally. That's what you're seeing right now.
So to amplify that, the last quarter, the negative free cash flow was a disaster. I think they were expecting $600 million positive. It came in, I want to say, at like $2.4 billion negative, which was an abject disaster on top of margins which have been decelerating. A couple quarters ago, they promised that we'd seen trough margins. That wasn't the case. The reason why the stock rallied that day was they told us that robo-taxis were coming a lot faster than the market thought, and then the subsequent trip to China. Of course, the problem with that is you need to get a license to operate in China, which I don't think he acknowledged or at least announced. And a lot of people, they're giving that stuff away in the first place. So I don't think there's necessarily going to be a revenue component to it, but it made for a great story. I'm not a hater. I'm not. But if you look at this company, at least the stock chart, as Dan just said, I mean, this is vastly underperformed a broader market over the last 3 years. And it's just getting down to levels where at a certain point it's going to start to make sense.
Yeah, no doubt. Listen, if you like this, tomorrow morning over breakfast, Guy and I are going to be doing it again. But we're going to go over some of the things that there's going to be a lot of earnings. We're going to go over some of the stuff real time, break down some of that stuff. So check us out 8 a.m. I think it's going to be out there during breakfast. We have to thank EY from SoFi, Liz Young. You guys should follow her at Liz Young Strat. She's got a lot of great data on the Twitter every day, and she has a blog, SoFi Investing blog. So check that out too. We really appreciate her coming down.
She's brilliant. She happens to be brilliant, and we're fortunate to have her join us and that's just factually true. There's people on CNBC, you turn the volume down when they're on. I'm one of those people. When she's on, you turn the volume up. So thank you, EY. And thanks, everybody, for joining us. We'll be back tomorrow at 8. Thanks, everyone.
Thanks, guys. That was awesome.